It's the SeizeYourBusiness.com podcast with Tony Rourke and Kevin O'Flaherty.
SeizeYourBusiness.com, making you money. Share it on Facebook, share it on LinkedIn, Twitter, our blogs, YouTube videos. Listen to our podcast, getting so hot that it's burning up the stereo.
Welcome to the SeizeYourBusiness.com podcast. I'm Kevin O'Flaherty from O'Flaherty Law, and my co-host is Scott Mathis from Plateau to Peak Consulting. If you find the podcast helpful, please review us on iTunes. That would be very helpful to us. Today we have John Moore and Alden Burnett as our guests. John is the author of Safe Money, and we're excited to have him on. Yeah, show the book. So if you find this helpful, please buy John's book. But John, why don't you kick it off and tell me a little bit about what you do and about the book.
Well, thanks for having us come here today. We really appreciate it. I'm the regional manager in Chicago for Federal Financial Group. I have about 38 agents who work for me. We concentrate mainly on the South and West and Northwest Indiana areas of Chicago, but we are nationwide as well. So if you ask for a copy of the book, I'll be happy, though, to give any of your listeners a free copy of it.
Oh, great.
I'd love to sit down with them at some point in the future. That'd be awesome. And this is Alden Burnett. Alden is my district coordinator, and we're here to talk about safe money and the enemies of wealth and how you can get out of risk in the market and have some guarantees along the way so that you're protecting your interest and principal. And that's the basis of the book.
And now just to dive right in here, you said there were 4 enemies to wealth when we were talking offline.
Yeah. One of the issues and problems that we face today, of course, is that while our incomes are always on the rise, it's that rising cost of living that's causing people big problems, and they tend to get into debt along the way, and it's the burden of that debt that causes them to feel lack of security in their own situations, and then they just don't save very effectively for retirement along the way. One of the things that I always ask folks, and I'll ask you, if I were to line up 100 people who are turning 65 today in the U.S., how many of that group of retirees are going to realize $33,000 per year in income when they retire?
Well,
what percentage?
I did a seminar with you, John, so I'd be cheating. So I'll let Scott answer.
You know, I think it's going to be low. A lot of people I talk to that are 50 plus, 60 plus have nothing. So I'm going to say it's going to be 10%.
I wish it was that good.
Yeah.
Unfortunately, it's not. According to IRS statistics, only 4% of the population will earn $33,000 or more when they get to retirement. And, you know, the evidence of that is everywhere we go in society, right? If we walked into a Walmart right now, the first thing we'd see are the greeters who are having to continue to work. Alden and I meet with folks every single day, and I can't tell you the numbers of people in their 50s and 60s who literally break down in tears in front of us when we do a financial needs analysis because they've got nothing going on. But beyond that, we have to talk about the Rule of 72, which talks about how long it takes to double your money at a particular rate of return. So let's just say we had 4% rate of return on our money. Now, that's something you couldn't get at the bank today, right? But if you did get 4%, that means it takes 18 years for your money to double at that rate. So that means if we have $100 in the bank and we leave it for 18 years, we come back and look, there'll be $200 in the account. Another 18 years, so 36 years now goes by and we have 400 and so on. But the point of the story is that $400 is going to buy what the $100 does today, 36 years from now.
Probably not, because inflation will probably be more than...
Right.
Bingo.
And so that's the number one enemy of wealth, inflation. Inflation is a big deal. If you guys all take out your smartphones right now and you look up inflation on Google, what's the rate of inflation in the U.S., you're going to get 4 government calculators, and they're all going to claim it's at 0. Well, does that even make sense?
No.
Otherwise, a loaf of bread 20 years ago would be the same price today, right? So do we trust the government? Show of hands. Anybody? No, not so much.
No. Not so much.
All right. So when, as a retired person or as a person that's shopping and buying groceries and so forth, what we care about is consumer inflation, right? The cost of goods and services. Well, any person with much of a brain at all knows that costs of goods and services are going up constantly all the time. In fact, inflation right now is at 4.1%, and it's been that way since 2010. Before that, it was at 3%. So if you take our Rule of 72 and do the reverse of that, if you earn $100,000 today, what's that going to be worth 18 years from now? If you do the same math, turns out it'll be half of that. That same 100 is only going to be worth 50 grand. Another 18 years forward, that same 100 is going to be half of that, which means it's only going to be worth $25,000. So how does that feel in retirement? You want to make sure that you're managing the lifestyle you've become accustomed to, right? Mm-hmm. So the 100,000 that you think you might have going on for retirement might not be there when you get there because of inflation.
And we find, John, don't we, all the time, individuals and even small business people who are doing all the right things that they need to do for their families are caught in this trap, and they don't see a way to get out from out of that trap. Yeah.
Well, right. Even in my own head, when I'm thinking, how much do I need to make a year to retire? Well, I make X amount now, and I'm living a comfortable lifestyle. That's what I'm going to need in 30 years, and
plus
obviously, that's wrong. I'm going to need about 4 times that. It sounds like.
Plus, you want to sustain whatever that number is throughout your lifetime, regardless of how long you live.
Sure.
That's the key, right? The second one is interest, right? Interest is a big deal. Did you know that interest takes a big bite out of our dollar every day? So if we all earn $1, statistically about 34 cents of every dollar goes toward interest. So think about that. You're paying all those creditors. You're paying for your mortgage. You're paying for your cars. You're paying for your credit cards. You're paying for store credit, and on it goes, right? So the interest that you are spending along the way, about 34 cents out of every dollar goes to interest payments alone.
Wow.
So
that hurts.
Okay, but we're not done yet.
That's a lot bigger number than what I would have expected.
We're not done yet, though. Wait, let's spend some more of that dollar. So number 3, enemy of wealth is going to be taxes, right? Taxes are taking a huge bite out of our savings over our lifetime. So the big myth is that if you save in the Wall Street model, that's great, right? We're not paying taxes today, but we are going to pay taxes in the future. So today's rate is about 28 to 33% or so, a little bit higher if you're in a higher income bracket, a little lower if you're in a lower income bracket. Your accountant can mitigate that to some degree, but still a large chunk of your dollar now is going to taxes. So by my calculations, we're left with about a third or so of our money, maybe 40% after we paid for inflation, interest, and taxes, right? And so we're in a pickle here. We don't have a whole lot left over, right? And so the big thing that people are doing today that they shouldn't be doing since the 1980s is they're saving in that 401k model, that Wall Street model, because market loss is going to be number 4. Right?
Before you go on to number 4, what do you mean by the Wall Street model exactly?
The Wall Street model is saving in that deferred tax account, okay? The 401k, 403b for teachers, 457 for union employees, and so on. Now, those are not savings plans per se, but they're tax laws that govern how you're able to keep and save your money over time and the way that's going to be regulated, right? So as we save in that Wall Street model, let's think about that. Do you know what the average investor in the United States earns on their market account?
I would say 10%.
6.
I wish it was that good. Unfortunately,
that good.
According to Forbes and some other sources, it's only about 4% per year. Okay. 4.5% on the outside. If you actually have a managed account, which is intensely managed on a regular basis, you might earn about 6%. Okay. Out of that, though, you have to pay those brokerage fees. Typically, the average brokerage fee on an account is about 2% per year. So deduct that from the 4, you're at about 2 or so, 2.5. And we can show statistically over time that that's the way it's been since about 1987. So that's not too good. You also might want to look up John Bogle. He's the former CEO of Vanguard. He said in a recent Forbes article that the average investor only realizes at the end of the day, after all is said and done, about 37% of their money. So where did that other 63% go? Anybody know?
So that's 37% of their initial investment?
Their whole investment. The whole enchilada.
It's not that they're making money. They're only getting 37% back.
They're only realizing about 37% return overall of their money.
Oh, okay.
Okay.
So that's going to taxes, inflation.
Who gets the other?
Loss.
Market the market gets part of it and federal government gets the other part.
Okay.
Right? Okay, so we have all these enemies of wealth. Well, how do people save their money over their lifetimes? Well, typically there are a couple different ways to save. The first way is in a bank, right? The bank is FDIC insured, so that's a good thing. Unless the government suddenly goes belly up, we'll probably be safe in the bank. So safety is a good deal in the bank.
John, before you go on, I just
Sure.
want to. So the fourth enemy was market loss.
Market loss.
And that's just putting your money at risk and actually losing it
Yes.
in the market. Okay, go on.
Think back to 2008.
Right.
Yeah.
Right.
The funny thing is when we meet with folks on a regular basis, we ask them, do you have copies of your statement? If they even know where they are, they typically bring them out to the kitchen table and the things have never been opened.
Sure.
And the reason they've never been opened is because people are afraid
There's
to look in there and
anxiety,
find out
yeah.
what's going on, right? So market loss is a big deal. It does take a lot of your money away from you. And the market doesn't even call it a loss. They call it a correction.
Correction.
Right.
Right.
So that's nice, right? Makes you feel better when it's just a correction. You still own the position, but you've lost where you were. Now you're operating from low ground.
And you can't liquidate in the short term if you still want to make back what you've lost.
That's right, because you'll pay taxes and plus a penalty if you liquidate that account.
So
what we do is show you a better way where you don't have to use those kinds of rules to manage your money.
So to
along the
recap
way.
the four enemies of wealth, it's inflation, interest, taxes, and market loss, right?
Yes,
Okay.
correct.
All right, go on. Sorry to interrupt.
That's
Just want
okay.
to make sure we're clear.
Yep.
Not everyone gets to see your diagram.
Okay.
So.
So in a bank account, the money's safe. But as we know today, bank accounts don't pay much of anything. So interest rate on a bank, I'll use BMO Harris as my example. Recently, they had 0.05% rate of return. That's 0.05 of 1%. So if we use the rule of 72 there, how long does it take to double our money at that rate? It's 1,440 years. Okay, so that's pretty good.
Yeah.
We're all going to run down to BMO, right? So that's a problem. Other than the safety factor, the bank's not going to do much of anything for us. The second way is through the stock market, right? And people go to the stock market because of that potential for a double-digit return. That arrow goes up, and they love that, right? There's sort of a gambling aspect to this too. But the problem with the stock market, of course, is that arrow goes the other way, and we could lose our money, and we call that risk. In fact, our money's at risk every single day in the market. If we look at the markets over time, what we'd see from 1929 to 1987 would be a nice, really straight line graph, and we'd grow at about 11%. But then after that, in 87 to today, we've had tremendous volatility up and down in the market. So when that volatility happens, we love the market when it's on its upside, but the market runs in cycles. About every 2.4 years, comes crashing back down again. Every 7 years, even bigger corrections in the market. And so when you're always operating from that low ground rather than operating from an established high ground that you can't lose, that's what makes all the difference in the world.
Now, question, John. In stock market, when you're referring to equities like mutual funds and different types of variable products, would you also include in those real estate investments? Would you consider that
Yes.
something that would fluctuate also?
Yes, certainly, because I experienced that myself. I talk about it in the book. We bought our house and built our house in 2004 at the height of the market, and a couple of years later, now we have the banking crisis. The bubble bursts in the market there, and the value of our house went dramatically down, as did a lot of other people. It's kind of interesting because Bernanke this morning was talking on Fox News saying that he doesn't see any foreseeable bubbles coming up in the near future. Well, holy cow.
Foreseeable
Did I get a
bubble.
chill up my back when he said that? I'm scared to death now because, and I was before that because I pay attention, but I'm really worried about what the market's going to do. Plus, we're at the end of our 7th year cycle here from the 2007, 08, 09 banking crisis. And so what does that mean for the future? Also, just a side note, we have to go back and think about taxes and interest rates. Taxes, they admit to 18.1 trillion in debt right now. Again, do we trust the government? I don't. I think that number is certainly much higher than that. But it's kind of funny, and I talk about this when I meet with folks. We talk about millions, billions, trillions all the time. But how big is $1 trillion?
Can't even conceptualize it in your brain. Yeah.
Take out your phone and Google it. How long would it take me to count to 1 trillion? It would shock you to know probably it's 35,000 years. If you started today and never stopped and set a number every second, which of course at some point the numbers get so big you could even say them that fast.
And I would die. You know?
Yeah,
Well, yeah, there's that.
I'd have to give up.
Yeah, it's 35,000 years. That's 1 trillion. So wrap your mind around how much money that really is. Will taxes go up in the future? Absolutely. Not only that, but there's only 47% of us that work and pay taxes right now. And that number's going the wrong way. So how's that going to affect taxes in the future? And so when folks tell me they've decided on that 401k plan, I understand, because that's what the government wants you to buy. That's what Wall Street wants you to buy. And those are big entities to work against. But boy, kicking that tax can down the road to me doesn't make any sense. Your tax liability is certainly going to be a lot more in the future. And so they're going to get a bigger chunk of your bucket. So unless you like to pay taxes, then you probably should look at some alternatives.
Well, and you hear people complaining about taxes today, and you look at the graph of what tax rates used to be, and we're at the nadir of that. We're at the actual low point by a large margin, so it's not going to stay there forever.
People don't get that though, right? And
are there any safe havens though, John?
There are. So indexing is a way to save your money, which is the third way to save that I was going to talk about. Indexing is a way for you to save your money with an insurance company and mirror the growth of an index over time. When you're mirroring a growth of an index, you don't own position in the index, so you don't own stock in the index, but the insurance company is going to allow you to mirror that growth. And so this is the way this works real simply. The index has a floor of 0 and a cap of 13. So no matter what the market does, you can't get less than 0. Whatever the market does, you can only get up to 13. So that's a trade-off. Insurance company's going to make their money above the cap.
And just to back things up for people who aren't as sophisticated as you guys, an index is basically a collection. It's not a mutual fund. It's not managed. It's just a collection of stocks. So you can get an index of the entire S&P 500.
Exactly.
Stock in all the companies on the S&P 500.
Exactly. So S&P, let's use that as our example. If we looked at S&P 500, which is the average daily stock price of the 500 largest corporations in America, if we looked at time and what its value is over time, if we looked at the last 25 years, which of course would include the worst of financial times in our country, the banking crisis, 9/11, Black Tuesday, and 87. Even through those terrible times, we've managed to average in the S&P almost 10% per year. But, if we go back even further, 85 years ago, it's at 10.8% over that long period of time. So that just demonstrates a real consistency to the S&P over time.
The trick is keeping that though, right?
Yes. So when you think about it, those 500 largest corporations, they haven't changed out much over the last 25 years or even 85 years. It's basically those same core group of companies in our country, right? It's 70% of our total equities market, and it's essentially our entire economy. So it's huge. So anyway, the insurance companies buy very long-term bonds, and then they buy options on those bonds, which sets what's called the cap rate, and currently it's at 13. Some of our products, the floor is at 2, some are at 6. It just depends on what kind of product you're in.
So explain to me what these ceilings and floors mean.
Okay, the floor means you can't ever get less than whatever the floor is.
So never, if the floor is 0, you're never going to be losing money.
No, if the market got minus 20, minus 30, minus 50, you'd still get 0.
Okay.
But if the market gets 0 or 1 through 13, you'd get whatever that was.
Okay. So
if it's over 13, then you would just get 13.
Okay. So it's a way to kind of hedge the market a little bit.
Exactly.
A safer
Support
play.
and hedge.
Mm-hmm.
We have some annuity products that guarantee 6% or 7%. We have 2 of them. The lesser one is for 40 years and older, and the 7% product is for 55 and older. Those are products that are meant to be committed for a length of time. Generally, they're 10-year products. You can withdraw early, but there's a penalty to do that. The other thing is on the 6% product, we're going to give you 4% of your total first premiums deposit as a bonus. Okay, and on the 7% product, we give you a 7% bonus on that one. So, but you have to be 55. and we'd love to sit down with people and
that's
show them
something
how
that
those work.
we should go into those annuities in detail if that's something you want to cover, because that's a really confusing thing.
It's a different subject, sure.
And I don't mind covering it today, but I want to hear more about this ceiling and floor insurance product.
So these are 7702 plans under the tax code, which is life insurance. Life insurance is written by lots of different companies in lots of different ways. I talk about that extensively in the book. The main thing to know is that the products that we write and the companies that we write for structure their products so that the cost of insurance is at its lowest and giving the client then that accumulation of cash value over time so that there are large dollars available to them later. So it's long-term savings that's meant to be long-term income in the end. Also, if you save in a life insurance product, the greatest thing about it is that it's tax-free. So the income from your cash value, the income that you take from the product later on, or the death benefit is all tax-free money. And so now, instead of giving third to the government, we're going to keep that third.
So just to be clear on this, you get, and what are these plans called again?
7702 plans.
So you get
under the tax code.
7702 plan, and you're indexing a particular segment of the market.
Yes.
And following whatever the market does.
Yes.
If the market loses money, if your floor is zero, you don't lose money.
Right.
If the market makes more than 13% or whatever the ceiling is, you don't make more than that, but you're at least
you're getting
going
your
to
13.
make that ceiling.
You're going to get the upside.
So you're not going to lose the money you put into this.
Right.
And you get a certain percentage of the upside, or at least you get a cap.
You get 100% of the upside up to that ceiling.
Right. And you can withdraw this money from the plan at will.
No 59.5 rule, no 70.5 rule.
No taxation.
And it's not taxed.
No taxed.
Okay. And so the downside, I suppose, would be you're paying a premium or a management fee for these plans, right?
You are paying a management fee or insurance fees, cost of insurance along the way. But again, these plans are structured so that we're minimizing that cost of insurance, unlike a whole life policy, unlike a universal life policy, unlike a term policy. We're managing that so that it's at its smallest amount based on the amount of insurance that you're buying.
Okay.
So that's set by the IRS. They determine what those ratios are. But we set it up so that the cost of insurance is at its lowest, allowing the policy to grow at its maximum along the way.
Okay.
And I'll show you how that works here in just a second.
I will let you do that for me.
One of the other great things about it is that they're flexible premiums. So clients can save as much or as little in the policy as they want to. And we structure that based on what their particular needs, what their goals are, and what they want to accomplish along the way. One of the biggest things, though, is just getting a plan started and getting it in place, because most people don't have anything going on.
Mm-hmm.
If you look statistically, and again, I talk about this in the book, statistically, most Americans have nothing going on for their retirements. And that's pretty sad. I talk to people every day who cry when we get to this point, and when I ask them, what are your dreams and goals? What do you want to do with your life when you get to retirement? And most people say, I'll never be able to retire. I'm going to die in this kitchen where I'm working, or, they're going to find me face first on the griddle because I got nothing. I'll have to work until the day I die. So that's pretty sad, and that's not good.
Yeah,
and so with these plans, you're also, in addition to the investment, you're getting life insurance?
Yes. Yeah.
Okay.
So on a flexible plan, I'm going to use $10,000 as an example only because it's easy math. Again, you could save as little as $25, $30, $50 a month, or sky's the limit. So if we look at 5 years of time, let's look at indexing versus, indexing would be the indexed universal life policy and how indexing would work, or an annuity product that uses indexing as well. And we'll talk about that versus the S&P 500, which is the actual market. Okay. So let's say S&P gets a 10% return. Equity index is going to mirror that growth along the way, but never the downside. So the $10,000 initial deposit now grows in the first year to $11,000 because we made 10%, right? Second year, let's show, again, easy math, another 10% return. Equity index mirrors that growth again along the way. So now both accounts grow again from 11 with a 10% return to 12,100. But of course, the problem is that the market loses money. And so if we show a loss in the third year, let's say the market lost 20%. That could happen, right?
Mm-hmm.
Sure. In the banking crisis, the market lost 43% of its value, something like $7 trillion domestically here in the U.S. So it goes from 12,100 and falls in value to about 9,600, right? That's the bad side of the market. We can lose our money there because that arrow does go the other way and it doesn't always go up. But an equity index, because we don't own position, we're just using it as a mirror for growth, and the insurance company is guaranteeing that once the interest and principal are swept into the account, they're protected by contract and they can't come back out. And so that's the beauty in equity index, because we're going to hold our value then at 12,100 in your account. Let's say the market has 2 years of losses in a row and it drops 17% the next year. 96 falls to about 7,900 in value. Again, equity index doesn't take the loss. So we're going to hold the value at 12,100 in your account. So we're 4 years down the road here. If we just made it back to even in our market account from 7,900 back up to 10 grand, we'd need a 30% return to do that. That's possible, but how often does the market give up 30% returns? Not too much. And interestingly enough, we need 70% to catch where we are in the index strategy. Okay, so 5th year, let's say the market comes back, and then the 5th year it has a good year and it gains 15%. So we've had 3 years of gains and 2 years of losses in the market. 79 with a 15% return grows to about 8,900. But hey, we're 5 years down the road here, and we're still 1,100 under our original principal. Plus, we lost all that interest that we made.
Now, John, can I interrupt? Is this typical for many investors? This seems almost what many investors would have lived through.
Yes, typical losses can be seen, and we can give people graphic illustrations of that, of actual market numbers along the way to show them that. But the beauty in equity index is whenever there's a gain, we're going to participate in the gain. This year, the market got 15, so we'll be capped at 13, right? Mm-hmm. Can't get over the cap, but 13% on 12.1 means we have 13,670 in our account. And so it's an easy question. Where would you rather be? At risk in the market where you're going up and down all the time, you're on that roller coaster of the stock market? Or do you want to hold on to your interest and principal and protect it along the way? The other beauty of it is that as we go along through the year, we're protecting your money. It gets swept into the account twice a month on the 11th and 24th. And that way, then it's like a check valve. It can't come back out. Okay. And so you don't lose it. And so in that way, if I could just show you another graph, we're going to always operate from the high ground. So the market takes an increase and then it loses. When it loses, we plateau. Market takes an increase and then it loses. We plateau. Increase, plateau, increase, plateau. And so in that way, we're always operating from this high ground along the way and never from the lower positions where we've lost money. That's the power in indexing. That's how you hold on to your money over time. But the other side of that is taxes, because taxes are going to take a big chunk of this along the way. And if we could keep that extra third for ourselves along the way, boy, now we're really making progress in what we're going to earn over our lifetime. I asked you before, what does a market account earn? About 4 to 4.5%. You guys can look that up and Google that. That's average rate of return in the United States on the market accounts, but that's a gross amount, right? Because we have to deduct our brokerage fees from that. Typically, brokerage fees are about 2%. So now you're at 2 to 2.5% on your rate of return. In Index Universal Life Products in the company that we write for, which is Accordia Life Insurance, we hit 8.2%, 98.7% of the time, and that's based on 25 years of performance in the policy. So those 25 years, again, they'd include the banking crisis and 9/11 and Black Tuesday. And still in all, we're hitting that 8.2% almost 100% of the time or better. So when we do annual reviews, Alden and I sit down with our clients every year, and we bring the illustration that we showed them today of what we said the product's going to do in the future, and then we bring our statements of what actually happened. We're always within a couple of dollars of what we said.
Now, how would you, if you're indexing the market, how would you make 8.2% in years that are down? years.
Because we're not losing along the way, and it's averaging out over time,
Okay.
and so statistically we can show an 8.2%
So it's an
return.
average over time.
Yes.
Okay.
Yeah.
I gotcha.
As is this number, the
four.
the market loss number or the market gain number.
Okay.
Yeah.
Now, Kevin, a question. So you and Scott, we all meet with a lot of business people, correct?
Yes.
And there are probably business people that are watching this podcast right now. John and I, I'm certain, have instances where business people have struggled with ways to save. They're in their businesses on a daily basis. How often have you seen that, Scott?
Often.
They may be brilliant people, but how often does a dentist or anyone running a private practice, how much time do they have to actually spend monitoring the market? Do you have a lot of time to monitor the market?
Nope, very little.
Not much. What the viewers of the podcast will also find is, as individuals, this works very well because it sets a foundation where you can't lose any dollars, which is critical.
Right.
For businesses, though, Scott, how many business owners have you ever met that have a partner?
Lots.
50, 100? 1,000?
Most people have partners.
Right.
Every business nearly has a partner. Yeah.
Right. Well, I've got a half a dozen instances where I know where there are business owners who have set a plan like this up, and a plan like this is what has kept them in business.
Interesting.
Either due to the protection that it offers a business partner, so that if someone passes away, there's a way to take care of that partner's family, because that's all the bereaved wants, is to be taken care of.
Right.
These plans also build cash value over time, so that a business can actually use that as a way to give themselves a loan for business expansion.
Sure.
I have clients who've got tens of thousands of dollars in cash value in plans like this. If they want to use the cash to, say, buy a piece of income property or open a new branch somewhere, they don't have to go to the bank and ask for a loan. They can go ahead and call Alden or the insurance company and say, I have $50,000 in cash value in my policy. I need to get $30,000 pretty quick, and we'll get it to you within 5 to 7 business days.
So when we're talking about cash value, go ahead, Scott.
Is there a penalty on that, or is there a percentage, or?
Well, great question. That has to be handled carefully because there can be penalties. But John and I and good legal counsel will do our best to make sure that doesn't happen. Now, I'm not an accountant.
No, I meant like an interest rate. Do you charge you for your own money? I know if you go into an IRA, if you get penalized and you could borrow your own money, but at a certain rate,
right.
If you pull it out, you get hit on the taxes. So
John and I can address that individually with people.
Sure.
So what we have to do is we have to at least keep 10% of cash in the policy to have it continue in its tax sheltered or tax free status, and we can sit down and work with individual clients about how best to do that. But there are certainly ways to get those dollars out without taxation. Early on, sometimes there is a small percentage of interest that you might pay, but after usually 10 years, you pay 0% in order to access your own money. It's called banking on yourself, which is also shown in John's book. In fact, there's a chapter specifically in John's book that he put together that is specifically for business owners to look at.
Yeah, business owners can incentivize employees in a variety of ways, either through key person insurance or executive bonus plans. Then the employer is going to have a separate contract with that employee to spell out, maybe production standards. Once they're met, additional premiums can be put into a policy or whatever. If it's a key person situation, the company is insuring themselves against the loss of that key person, whether they're going to just leave the company or whatever the situation might be. And so when they're saving in their own policy, naming the corporation as the owner and then the corporation as the beneficiary of the policy, they're building cash value that shows up on a balance sheet. They can use that for creditors and whatever else, but it's also money that they can access as time goes on to use for themselves. So it has a lot of really great applications for businesses.
One thing that I've learned in working with, business owners and talking about financial planning is that there's very few magic bullets that are, the best situation for everybody.
Sure.
Otherwise, that would be the only solution.
Right.
What are the people to whom this might not be a good solution for?
Yeah, that's a great